Good morning. This is Bruce. It is Saturday morning, the 22nd of January, 2022. Just wanted to give you a short video, show you my screens, show you what I'm looking at and the analysis that goes on behind the scenes so that maybe you'll better understand some decisions that are made. So what we're going to do is we're going to start and we're going to look at, obviously we've been in a very, very difficult market for the last couple of weeks. Actually, we've been in a sideways and difficult market since November. It's just been a really difficult time following a fairly strong time. And when it comes to risk management, the difficulty is to figure out when to sell and then when to buy back in. When to sell is somewhat easy, but the problem is you generally miss some upside. Again, you miss some downside, which everyone's very happy about. But when the market springs back, which it tends to do, and that's what I'm going to show you this morning, you miss quite a bit of that upside and you give away quite a bit of return. When that happens a few times a year, you feel good when you're saving money, but you absolutely do give up some return. So what you're looking for is a preponderance of evidence to help you make a decision. What we're looking at, and you may want to have pen and paper for this, because I'm going to give you a number of different data points. We're looking at the S&P 500. SPX is the S&P 500. We're looking at a daily chart. So each candle, as these are called, is one day. So this is Friday. It was a very bad day on Friday, and Thursday, and Wednesday, and Tuesday, and so on. And the lines that are going across, probably the most important ones you want to see are this line here, which I'm highlighting. That's the 50-day moving average. And then the red line is the 200-day moving average. The reason these are so important is because institutions worldwide use these as areas of support and resistance. For instance, it is pretty normal when the market's coming down for it to come down to the 50-day moving average and then to bounce back up off of that average. Came back, went a little bit below the 50-day moving average, bounced back off. So that's the first level of support in the market. We thought it came down below, it bounced up, and then it went below again, and then it has fallen. So once it breaks below the 50-day moving average, if it's going to do that, which this clearly has, the next line of support, I'll explain to you more what that means in just a second, is the 200-day moving average. And you can see on Friday, we spent a lot of time right around the 20-day moving average, and then just the last half an hour, the market fell just a little bit below it. The reason these are general support lines for the market is if you think of the multi-billion-dollar pension plans and mutual funds out there, they have, like I said, billions and billions of dollars. And in order to protect their portfolios, when stocks get down to around the 50, they'll start pumping money into the market to support, that's why these are called support, to support the market. And they'll do that pretty much every time. But the market is a mechanism of supply and demand. And when there's more selling, so much more selling than buying, that support doesn't work. The next level of support is the 200-day moving average. And what I would expect to see here is a bounce off of the 200-day moving average. That doesn't mean that's going to happen. It just means that's what I expect to happen. And let me show you why. A few different data points that I'd like to show you. Before I leave this screen, that 50-day, when the 20-day, which is the gold color, crosses below the 50-day, we're in a market correction, and we're just about there now. We're almost in that correction territory now. When the 50-day moving average crosses below the 20-day, that's called a bear cross, and we're nowhere near there yet. Don't worry about this line. This is a trading line. That's for something else. The 50-day is nowhere near crossing below the 200-day. If it did cross, then we're in what's called a technical bear market, but we're not in a bear market, and I don't suspect we will go into a bear market. So that's the first thing I want to show you. So what type of research can we do and what type of evidence? We're looking for a preponderance of evidence of what's going to happen next, because as a money manager, one of the sayings we have is that we live on the right edge of the chart. We live here. Here was Friday. We don't know what Monday is going to bring yet because it hasn't happened. Okay, something you might want to write down. This is a quote from a mentor of mine back in the mid-'80s. His name was Charles Brandis, who was a very, very well-respected institutional money manager. And he said, the risk of being out of the market during up days is greater than the risk of being in the market during down days. Now think about that for a second. The risk of being out of the market during up days is greater than the risk of being in the market during down days. And what he meant by that is, if you're in the market, which we are to a large degree, and the market's going down, it always comes back up. I can't tell you when, but it always comes back up. If you are out of the market during up days, you can never get that back. Those days are gone. So the risk of being out of the market during up periods in the market is greater than the risk of being in the market during down times. I hope that makes sense. That's an important concept to remember. But we don't want to be in the market during down times and just let this fall off a cliff and fall forever. We're always trying to avoid the big 30, 40, 50% declines because they take so long to make back up. But a 5 or a 10 or even a 15% decline, that is something that is not terribly difficult to make back up. As a matter of fact, before I go to the next slide, I'm going to pull up, bear with me one second here. I sent this in a morning email the other day, but just in case you didn't read it, or maybe if you didn't understand it. This is from one of the chief strategists over at Zacks Investment Services. And he was just saying, and this was sometime late last week, like Thursday, he said stocks closed lower yesterday with all of the indices in the red. As it stands now from the recent highs, the Dow is near pullback territory. It's down 4.29. Now, this is a couple of days ago. It's down more than that now. And the S&P is in pullback territory, down 5.01. The NASDAQ is in correction territory. It's down 10.5%. A pullback is defined as a decline between 5 and 9.99%. That's what a pullback is. And stocks usually pull back about 5%, roughly 3 to 4 times a year. Think about that this is not abnormal. This is normal. A correction is defined as a decline between 10% and 19.99%. And by the way, a bear market is 20%. Stocks usually correct about 10% on average once a year, okay? These are common occurrences. Now, here's the real kicker, because last year was a very good year for the markets return-wise. Last year, we saw roughly 3 pullbacks last year for the Dow and the S&P 500, all while the markets went up 18.7 and 26.9% respectively. Very key sentence. The NASDAQ saw a correction, 10% or more last year, and it finished up 21.4%. And now the markets are at it again. But these are the pauses that refresh before the next leg up. So here's the point from this, that these pullbacks that are frustrating, they're painful, they're stressful, they can cause loss of sleep, I can go on and on and on and on, are not abnormal. They are part of the market. For instance, I'll show you something else. What is a trend? Well, let me grab a little drawing stick. And again, I sure hope you can see this. For a trend, the market goes up and then the market comes back down. And it normally comes back down, 50 to 61.8%. Why so specific? These are Fibonacci numbers. These are Fibonacci retracements. And if you want to read about something that is absolutely fascinating just Google Fibonacci or do a YouTube of Fibonacci. But in any event, the markets go up and then they retrace about 50 to 61%. And then the markets tend to go up and then they retrace about 50 to 61.8. Then they go up and then they retrace. Now, what does this mean? This means that you have a series of higher highs and you have a series of higher lows. That is the classic definition of a bull market. But in that bull market, these retracements can be painful and scary. And one of the reasons they are is because we have built into our brains this thing called an inertia effect, which says when the markets are rising, our brain thinks they're always going to go up. And but more importantly, when the markets are falling, our brains think that they're always going to fall. In behavioral finance, it's called inertia. And neither of those two things is true. So when you have a series of higher lows and a series of higher highs, you are in a bull market. Now, the longer this high goes, the deeper this pullback can be, because it's always going to fall back within a certain range. Not always, but the preponderance of time. And if we look at the markets, we had a pretty long, let me clear all of this out. Bear with me. And I'm going to go back here. If I were to scroll backwards, I can move a few things here. Okay, if I were to scroll backwards, you can see we had a fairly long uptrend, and then the market came back. See how it kind of came to its 50? And it's about, if I were to measure, it'd be 50 to 61%. So the longer the uptrend, the deeper the pullback, which makes the pullback that much more painful, if you will. Okay, let me go to another piece of analysis. So we looked at the 200-day moving average as a level of potential support. Now let's look at some other pieces of data that I always look at. This is a company called VectorVest. You can see that up here. They've been around about 35 years. They have a very, very strong record of market timing and stock selection. And without going into a tremendous amount of detail, let me just tell you that the MTI, Market Trend Indicator, and this is updated every day throughout the day, the Market Trend Indicator is on a scale of 0 to 2. And what that means is that if the number is above 1, it's suggesting that the intermediate term trend is up. If the number is below 1.00, the intermediate term or trend of the market is down. You can see it's currently at 0.45. There's another thing that VectorVest has shown over 35 years, which is if the market MTI is at or below 0.60, which it is, that suggests to them that this market is sitting on or very close to a bottom. And they've shown this pretty consistently over 35 years. The BSR is their indication of a buy to sell ratio. So they're looking at how many stocks have a buy rating from VectorVest and how many stocks have a sell rating, and it is a ratio. Now, again, it's on a scale of 0 to 2. If the BSR is above 1.00, that's very positive for the market. There's more buys than sells. And if the BSR is below 1.00, which it clearly is, that shows that there's more sells than buys. So that's not real strong for the market. But when they look back over 35 years, when the BSR level gets to 0.2 or lower, which it is, again, their history says that's an indication the market is at or very close to a bottom. Now, the last part of this is VectorVest also says when both of these are below the thresholds they laid out, below 0.2 and below 0.6. When those happen simultaneously, their experience over the last 35 years is that we are getting ready for a fairly explosive rise to the upside. Okay, now let's continue with this. Let me erase this. So we've looked at the 200-day moving average, which is where we are. We've looked at the MTI below 0.6. We've looked at the BSR below 0.13. Let me clear these annotations and look at just a couple of more metrics. I'm going to go back to this chart. And again, I'm not going to go into significant detail right now. If you want detail on any of this stuff, all you have to do is ask. I'm more than happy, but just for the sake of time, I don't want to go into too much detail. There is an indicator called stochastics. When the stochastic is below 20, I need to get my, I need to get back here. Hang on one second. Let me go back to today. Oops. Well, let's try clear drawings. Let's go back to our mouse. There we go. Now we're here. Okay, so I'll get a drawing tool again. When the stochastic is below 20, which is a little bit hard to see here, but when it's below 20, that suggests the market is oversold. Does that make sense? That's just normal for a stochastic. And again, I'm just going to move some things around on my chart. There we go. So our stochastic is in fact below 20, which you can see. The other thing you can see is that green line looks like it's getting ready to cross back up above the pink line. That is a crossover, which is a bullish signal. And if those lines get just above this 20, that's a strong upward signal. So that's just another piece of information. Okay. One more on this page. Let's see here. Is, I hope this is making sense, and just bear with me for a second, this is called the RSI. And again, what we looked at before was called the stochastic, if you want to make a note. When the RSI is below, that line is at the 30 level. When the RSI is below 30, that indicator is suggesting that the market is oversold and ready to pop back up. So we've looked at the 200-day moving average right there. We've looked at stochastic, looks like the market's oversold. We've looked at the RSI, that looks like the market is oversold, right? And now let's go to just a couple other things, and then I'm going to put all of this together for you so it makes a little bit more sense. If I go back to VectorVest, we also looked at, let's see here. We also looked at the MTI, which is below 0.6. We looked at the BSR. Now, VectorVest has another tool in their market timing, which is called a confirmed call, or a confirmed uptrend, or a confirmed downtrend. So let's take a look at that. If you see this little red arrow right here, that was the last time they had a confirmed downtrend. And that was on November 22nd, right around Thanksgiving. And you can see it was a pretty darn good call because the market has fallen since then. Prior to that, you can see that this was a confirmed up, which was on October 14th. And that looks like a pretty strong call because they called it and the market went up. So if we stop right there, you might say, well, Bruce, go in the market when they have a confirmed up, go out of the market when they have a confirmed down. Oh, how I wish it was that easy. Let's look at a few others. Here's a confirmed up. That one didn't work out real well. Here's a confirmed down. It went down for a couple days, then sprang right back up. Here is a confirmed down. It did nothing but go up. Here's a confirmed up that went only down. So my point is, if it were as easy as just following one indicator, everyone would do it. We would all be filthy rich and we'd be happy and life would be easy. But unfortunately in the markets, nothing is that easy. But this is another technical tool right now. We have not gotten it confirmed up yet, but let's see what happens. One other thing I want to show you that I showed a client just the other day, and he liked this look. This is another tool that I use, and this is from stockcharts.com, and this is the S&P 500. And on the right side panel, what you're looking at is daily bars. So each bar represents one day. And on the left side panel, you're looking at the same thing, the S&P 500, but each bar is 1 week or 5 trading days. So a couple things that I would highlight for you here. If we were to go back to, let's just say here, let me get this here. Bear with me one more second here. Okay. If we were to look at this market and we went back to 10/20, so October 20th, if you see that vertical line, that's October 20th. And on the left panel, there's also a vertical line. That is also October, well, that's October 18th because it's looking for a beginning of a week. You can see how smooth this looks. This is like, well, that's no big deal. We're just in an uptrend. We've had one bad thing, but but this is what that same thing is if you look on a daily basis. Interesting, isn't it? So before this last week, that's this last week, this just looked like it was fine. It was just in a clear uptrend, even though we were experiencing tremendous pullbacks and volatility and so on. We had one really bad week, which was last week, but then what we do, we have another saying in analysis called look left to learn. Have we seen that before? Well, clearly here was a really big pullback and the market just kept running back up. I mean, so we see this from time to time. This was the COVID drawdown in early 2020. But even then, we had this tremendous pull down and it came back up. And this really supports Mr. Brandeis's comment that I started with, which is there's a greater risk being out of the market during up days than being in the market during down days, because the market always does come back. But this has gone down in the past 50%, and none of us want to see our account go down 50%. So what I'm doing is on a daily basis, is I'm looking at all of this analysis that we've just gone through in far greater detail than I shared with you just now. And I'm looking for a preponderance of evidence. Well, what is the preponderance of evidence showing now? Number one, on a weekly basis, we're still clearly in an uptrend. Number two, based on the 200-day moving average, this market could be finding support here and getting ready to bounce. Based on the MTI, which is below 60, 0.60, it looks like the market's looking for a bottom. Based on the BSR, below 0.20, it looks like the market's looking for a strong bottom. So I can go on and on. And so the question is, or what you would be asking yourself if you were managing someone else's money is, what's going to happen next week? Are we going to continue to fall? And if you think that's the case, you should probably go to cash. But based on the evidence that I've just shown you, including stochastic and RSI, the preponderance of evidence, let me get another drawing tool for a second, is that, and it might not happen Monday, but we're talking soon, that this market could start having up bars. We could start moving back up. That's what the evidence is suggesting. So the question is, should we get out of the market now to avoid any additional risk? That's an option. Or should we, based on the preponderance of evidence throughout history, see if we're going to get a pullback and make back some of those losses? That's the camp that I'm in. I don't want you to miss this. But if we do get a significant pullback over the next week or two, that's great. We'll all be feeling happy. But then these numbers or these lines that were acting as areas of support, they become areas of resistance, which means, will we be able to break above those levels? Or will we turn around and head back down? Because just like I drew for you an uptrend, if I were to go back and draw a downtrend, we'd have a down, a retracement, down, retracement, down. We have lower highs and we have lower lows. So we've been in one of these retracements in an uptrend, but once it retraces, will it hit a point that acts as resistance and push it lower? Well, let's take a look at the chart again. If we go back to this chart, and let me, let's see if I can clear those annotations. Yeah. So if we go back to this chart and the market starts to head back up, actually, I'm going to go to a different chart, but bear with me again one more second here. I'll go to this chart. Because this is the 200-day, this is the 50-day. If the market starts to head back up, will we find resistance here at the 50-day? I don't know, but I can tell you if we get a confirmed up and this market starts to move back up and then we get another confirmed down, that's going to suggest to me that we're starting a new downtrend. I'm going to pull the trigger and get us out into cash. So I know that was a lot of information. It was more than 15 minutes. I went through it rather quickly, but this is the type of analysis and decision-making process that I go through every day, multiple times a day. I had a client yesterday say, do you also watch or read the news to see what's going on in the world? And the answer to that is yes and no. Primarily, it's yes, I do read it. No, I don't base decisions on it. And here's why. In technical analysis means charting. In technical analysis, technicians believe that all news is already built into the price. So there's no reason to read the news. The market's already reacting to it. It's already built into the price. The only news that makes critical or really moves into decision-making process, I'll show you this, is called the market climate. So the market climate, there we go, I'll move this out, is looking at a couple of things. Consumer price index is inflation. That's important. If we have runaway inflation that doesn't get controlled, it will cause a downward market. Inflation causes stocks to decline, not in the short term, but in the longer term. More importantly, we look at earnings. If earnings start to fall, let me see if I can get back to, there we go. Here's S&P earnings, earnings trend indicator. Earnings have been rising quarter over quarter for quite some time, which has been pushing our market higher and higher. If earnings were to start to roll over and companies are starting to not make as much money or lose money, that pushes the market down. So when it comes to earnings, we're still having good earnings. The vast number of S&P companies are reporting positive earnings. So that's good for the market. Inflation, let's say we have 3 or 4 interest rate increases in 2022, which I suspect we will. I think we'll probably have 3. We'll still be at historically low interest rates. We're coming off of almost 0. So if they push the interest rates back up to 2%, is that a huge drag on the market? No, it's not. So in the beginning of inflation, in the beginning of rising interest rates, that should not be a negative on the market. We're looking for these things to roll over and start to turn down before we start to predict or see a bear market. So we don't look at the everyday news. Those are just quick hiccups in the market. We look at earnings, we look at inflation. Those are the types of things, and interest rates, of course. Those are the types of things that we look at. So I hope this has helped. There's a lot that goes on behind the scenes when we're looking for really what to do with our money. Should we stay in or should we stay out? And remember, if you are watching it on a day-to-day basis, I can almost guarantee you that that's going to drive you crazy, because that's what I do. That's what I get paid to do. If you look at a longer term trend, boy, this looks a lot more palatable, doesn't it? You know, nobody's going to worry about risk, downside risk, when the market looks like that. It's the same market. So I promise you that I'm watching this every day. I promise you that I will make every decision that I believe is in your best interest. Remember that anytime I buy a trade for you, I'm buying it for myself, especially if you're a pure growth investor. So we're always in this together. And the last thing I'll say is, if this level of craziness, of volatility, and you're a growth investor, keeps you up at night or is causing you significant stress, you need to let me know, because then instead of being in pure growth, we'll go into defined outcome ETFs. And a lot of you watching this are already in defined outcome ETFs because you are more risk adverse. Remember, you're seeing your account go down, but at maturity of those ETFs, you get most of that money back. I mean, if we're in one that guarantees 15% down, and we're at 15% down on the 15% of a loss at the maturity date, it's like a 1-year CD, you get that money back. They put it right back into your account. So just remember, if you're in defined outcome ETFs, which a lot of my clients are, who are more risk adverse, yeah, this is annoying and you see your account going down, but just know that that's not a real account value, because you get most of that back at maturity. If you are a pure growth investor, this is what we have to accept in order to try to get higher rates of return. And I'm giving our portfolios more wiggle room because I don't want us to be out of the market during those powerful up times, but it causes us to have a little bit more volatility. So again, I don't want to make this too long. I plan on doing these types of videos about once a month. Obviously, it's only been about a week since I did the last one, but it's because the market is so bad and stress-inducing right now. I thought I'd share this one with you, and I'll just make a decision next Saturday whether we need another one. If not, I'll revert back to once a month. If there's anything else you'd like to know, if you want me to go through this in detail or slower with you, all you gotta do is let me know. I'm obviously more than happy to do that. And if you'd like to do a review of your individual account, again, all you have to do is let me know, and we'll schedule that. Okay, so I'm here, I'm watching, and let me know if you have any questions or concerns. Thanks. Bye-bye.